everyone. How's everyone going? Bitcoin not looking too good today, but it's always good to have everyone here. We're all here for the same reason. We all see a future in crypto. So today's session will be around navigating the complexities of crypto investing. So a little bit about me. My name is Kane Bisogni. I am head of research and analytics at UpTrade, a premium crypto brokerage. I've been investing in the space for about 7 years now. So I've been helping thousands of different people navigate the complexities of crypto, how to invest, what research to do, things like that. And where it all started with me was back in 2017. I was actually given $50 worth of Bitcoin from my cousin. I was 17 at the time, so $50 felt like a lot of money. And I got the exposure because I was really curious about the space. I was curious around what the technology was. And obviously Bitcoin was also, on a parabolic run. And I'm like, oh, there's opportunity here. So one of the big things I say to a lot of people is, if you want to fill your knowledge gap and understand what's happening in a market, one of the best ways is just getting exposure. That could be $50, that could be $100, it doesn't really matter. But that will help keep you accountable when it comes to actually understanding why my asset's gone up 10%, why my asset's gone down 10%. It's a really important thing because if you don't have that little bit of exposure, it just becomes hard to actually understand the complexities. So moving on, I actually was given the opportunity to work at a crypto fund called Apollo Crypto, an institutional crypto asset manager, one of the biggest in Australia. There I was doing institutional research reports, also helping with asset management strategy. From there, I moved on to venture capital. So I was working at one of Australia's biggest VCs, Upside DAO, in the crypto space. Here I was doing deal flow, so looking at the new biggest innovation in crypto, also finding which ones were going to be the big thing in the next couple of years. That was really, really exciting time for me. And then fast forward to today, again, I am working at UpTrade, so I'm head of research, and I'm also a co-founder of our new premium research company called UpTrade Alpha. So what you guys will be learning today: 1, what makes Bitcoin valuable; 2, why investing is important; 3, why crypto investing is important. Also, we'll look at the crypto global adoption curve, and then 4 analytical steps to success in crypto investing. So, number 1, why is Bitcoin valuable? I feel like there's a big misconception around what actually makes Bitcoin valuable. A lot of people don't really understand why this digital asset actually is something people want to invest in. And there's actually a few core things you need to be looking at when considering why people actually put value on this asset. And first of all, we can look at gold. Gold is currently the largest asset in the world in terms of market cap. Sits around $22 trillion in market cap. For example, and for comparison, Bitcoin sits around $1.7 trillion. So over less than 10% of the market cap of gold. Now, we've got a few different categories here to understand why Bitcoin is actually valuable and why people invest in this asset class. And these are just some of the value reasons. So for example, we have scarcity. Scarcity is extremely important when it comes to price appreciation. Everyone understands when there's limited supply, it means that obviously there's not enough to go around. So for example, Bitcoin, there's only 21 million tokens. There will never be another token over 21 million. Currently, there's 20 million tokens in circulation, so there's only 1 million tokens left to be mined. Gold, we all know that gold is scarce. There's only a certain amount of gold in the world. We won't go into synthetic gold and that whole thing that could be occurring. But then we've also got fiat currencies. They have unlimited supply. So governments can print as much as they want. And obviously there's no scarcity behind that. Then we can look at divisibility. For example, fiat currencies If you want to send someone $1.98, you can go send your friend $1.98. It's very easy for a medium of exchange. Bitcoin, the same. You can actually, it's divisible by 8 decimal points. So you can also use it for a medium of exchange. So if you wanted to buy something worth $10 using Bitcoin, you can do so. And then you've got gold. Obviously, you can't grab a block of gold, whack $10 off, and go buy a block of chocolate. It's just not very feasible in that scenario. Portability. Portability is extremely important. Fiat currencies, obviously, you can send that globally. If you wanted to send, obviously, like $1 million from Australia to China, you can do so, except there's settlement delays, there's banking issues, things like that that really stop you from getting the real experience you need. And in finance, a lot of institutions, everyone knows the time value of money is extremely important. Every minute, every second counts for these institutions, and this is what actually makes these guys, the millions of dollars they earn every day. So, every minute counts. And then you've got gold. Obviously, you can't just, travel with 10 kilos of gold on a plane. Again, there's limitations to that thing. And then Bitcoin. Bitcoin is very portable. You can send, if you wanted $1 billion from here to someone else in the world, and you'll have it in their account in 10 minutes. So Bitcoin does stand out in this category. Following on there, we've got censorship resistance. So Bitcoin is peer-to-peer, person-to-person. I can send you money, you can send me money. We don't have to worry about a centralized middleman to do that for us. Gold and fiat currencies, again, you do have to worry about that. There's someone actually moving your money for you. Durability, this just looks at have these ever failed? For example, Bitcoin has never failed in terms of the technology. It's got a really strong, now it would be 14-year lifespan or 15 years. Gold, obviously that's got a massive lifespan when it comes to how it's been utilized in our economies. And then fiat currencies, 600 out of 770 fiat currencies have failed. This is due to inflation, printing money. These are actually prone to failure. So that's something you need to understand when investing. Verifiability, this actually goes into the censorship resistance as well. So for example, Bitcoin, you see everything on the ledger. It's transparent. You can see where your money's flowing in and out of. You can actually see it on the blockchain. Whereas, again, banks, they can hide transactions. You actually don't know where your money is a lot of the time. You don't know if they're investing it in certain things, and that's why there's an issue with that whole system that we're trying to solve. The only thing that Bitcoin doesn't really have is an established history. That will come over time, and that is what gold actually has at the moment that stands out. Whoa. Cool. So why does investing matter? On the screen here, we have a chart of the purchasing power of the US dollar in the last 25 years. And in the last 25 years, your purchasing power has actually decreased by over 50%. Meaning that $1 you made back 25 years ago, if you were born back then, I think a few of you were, that $1 would only be worth 50 cents in the present value today. So that is why it is extremely important, because if you want to look at 10 years ago now, you've lost 27% of your purchasing power as well. So this is just showing the compounding effect of not investing your money or just keeping your money in a bank account, not doing anything. Sorry, this is like a bit fidgety. Oh, sorry. I just skipped a lot. Sorry about that. Awesome. So why does investing matter? Again, we've got the average house prices in the USA in the last 10 years on the screen now. So in 2015, one house cost $215,000. 2020, $356,000 could buy you that same house. And then in 2025, $450,000 could buy you that house. So when we're actually comparing the purchasing power of your US dollar compared to a growth asset, like real estate, you've actually lost more than 27% in those 10 years. You've lost over 50%. That's because you've sat on your money, you haven't invested it in things that are actually growing and actually beating the depreciation of purchasing power. So this is why it really matters. Cool. Alrighty. So on the screen here, we have Bitcoin in terms of these house prices as well. So back in 2015, 790 Bitcoin could buy you that house. 2020, 32 Bitcoin could buy you that house. And then now 2025, around 4.5 Bitcoin could buy you that same house. That was using $100,000 as a price. It's obviously come down a little bit now. But the really big point here is that not only has Bitcoin outperformed the US dollar by over 27,000%, if you want to account for the depreciation of the US dollar's purchasing power, it is still outperformed by over 20,000% in the last 10 years. So again, just proving how important it is to be investing your money in growth assets, things that actually have potential to make you money and keep your purchasing power. So why crypto investing matters. One, declining trust in traditional finance. So we've seen banking collapses, we've seen inflation eating our savings, like I mentioned before, and governments printing endless money. It's a big issue at the moment. Number two, institution adoption. This is really big for the last 2 years now. So we've got ETFs, major funds. We've got public companies actually starting to create companies based on digital asset treasuries like Bitcoin. Regulation clarity. So things like the Clarity Act, the Genius Act, these are actual frameworks being passed in the USA that actually are looking to innovate with cryptocurrency. So the likes of Trump, he's actually looking to innovate with crypto, make USA the global epicenter for crypto innovation. And then finally, innovation is moving fast. We have sectors like decentralized finance, we have AI, we have tokenization of real-world assets. These are major sectors that are building in our space. So I find this slide really interesting and it's pretty funny. This is around the institutional sentiment that has flipped. So back in 2017, we have Larry Fink, who is the CEO of BlackRock. He said, Bitcoin just shows you how much demand for money laundering there is in the world. Now, you fast forward to today, BlackRock is the biggest Bitcoin ETF in the world with over $80 billion in assets under management. Larry Fink also calls Bitcoin digital gold and an international asset. So a big change in sentiment from him. And then moving on, Jamie Dimon, he is JP Morgan's CEO in 2017. He said, if you're stupid enough to buy it, you'll pay the price one day. He called it a fraud. He called it a Ponzi scheme. Fast forward to today, JP Morgan now offers Bitcoin ETFs to all its clients and also had a price prediction for Bitcoin to hit $170,000. So hopefully that makes you feel a little bit better from where we are right now. And then we have Kenneth Rogoff, who is a Harvard economist in 2018. He said it's more likely to drop to $100 than ever reach $100,000. And we all know we well surpassed $100,000 recently. And Harvard University has actually invested over $450 million into Bitcoin ETFs since then. So here we have the institutional and country adoption curve of Bitcoin at the moment. So BlackRock is the biggest ETF and is the fastest ETF to ever reach $70 billion in assets under management. This is 5 times faster than the previous record holder, which was gold. And you can see on the chart here, the orange is the ETF of Bitcoin and the darker blue is the ETF of gold. So you can this actually shows you how quickly this has been adopted by major institutions, by countries, by governments. This is just a really good visual perspective on how strong this asset class is growing. Perfect. So these are the 4 topics I want to talk to you guys today around from an analytical approach that have helped me succeed year after year, outperform the market, especially since it's so volatile. It's just very important to understand what actually, leads to the volatility and how you guys can actually be best prepared for that volatility. So topic 1 will be the macroeconomic impacts. Topic 2 around market cycles and narratives. Topic 3, an analyst framework on on-chain signals, so certain things I look at. And topic 4, portfolio management and diversification. These are all things that I've been able to utilize from my experience at Apollo Crypto, at Upside, now at UpTrade, that have really helped me outperform. So topic 1 is around economic impacts, the macroeconomic impacts. So I think there is a little bit of a misunderstanding amongst a lot of people that crypto is immune to a lot of things that happen in the outside world, which is completely untrue. Realistically, crypto is actually one of the most volatile when it comes to the macro factors that affect every market in the world. But these reasons are because we are a 24/7 market. We also do have less liquidity compared to a lot of other markets. So we obviously have bigger ups and downs and swings to reactivity in different decisions. So a few things you need to understand, and this obviously will be really important when you're looking at times to invest, are things like the interest rate. So this is a major core driver and is a reason why we actually had this recent decline in Bitcoin's price, because the odds of actually getting rate cuts in the USA in December have actually decreased. So a lot of people find that as a bit of a bearish condition. So basically the interest rates, they determine the liquidity and the risk appetite of investors. So when central banks decide to increase their interest rate, that will usually mean borrowing becomes more expensive. People have less disposable income because people are trying to afford their mortgage. They don't really have enough money to spare. And what this means is there's a weaker inflow into risk on assets like crypto, equities do struggle as well at times during these times as well. And then on the other hand, when central banks decide to decrease the interest rates, we have what we call liquidity expansion. And what that is people start to look at different ways to earn higher returns on their money, because they're not getting the same returns they might get in their banks, they're not getting the same returns they might get in their treasuries, and often they start looking at things like risk on assets, and crypto obviously is one of the big ones. So then the other big one we look at is global liquidity. So liquidity is something you'll hear quite a lot today. And that basically is just the amount of investable, spendable money that is circulating around the world that is readily available. So we have things like quantitative easing, quantitative tightening. So quantitative easing is when central banks expand their balance sheet. It means that they're actually readily looking to invest in different assets or different markets. So that's why we see things like crypto start to rally. And then you can imagine during quantitative tightening, it's the opposite. They actually start to reduce their balance sheets. So they start to sell assets that they might hold in different markets. And that's why we start to see crypto corrections, or maybe what we call bearish conditions. And I'll quickly just mention, a really good example of this is back in 2021. So we actually had near zero interest rates during that time. We were in quantitative easing. Every single market was booming. We had, crypto was hitting all-time high. Equities were doing extremely well. Real estate was doing great. And we also had things like Pokemon cards, watches. They were all doing really extremely well, and they were hitting all-time high. And that's because everyone had more disposable income. There was stimulus checks. Everyone had money to invest in risk on assets. So it is a very different time period to what we have right now, because, again, we're in quantitative tightening, which is hopefully going to end in December the 1st for the US. And also we still have pretty high interest rates. So market cycles, so bull markets, we'll quickly go through this. So quickly on the screen, we have the halving cycles. As you can see, these are every 4 years, basically, Bitcoin halves in the amount of emissions or amount of Bitcoin being mined. So this is the rewards. So as I said earlier, 20 out of 21 million Bitcoin have been mined. So there's only 1 million left to be mined. And often we actually see really interesting historical trends for these types of events. So for example, the green box you can see is the bull market, followed by the red box, which is the bear market, followed by the yellow accumulation box. Now, the reason I have this on the screen is to show you that Bitcoin is predictable, because it does look kind of predictable when you look at it like that. But the actual real reason is because I wanted to show you the volatility of these different cycles, how it's become less and less over time. That's what happens with maturing asset classes. You start to see things become less predictable. You can't just rely on different historical trends, especially in charts. And obviously, a lot of people do look at this. A lot of people will look at the outside noise when it comes to things like this. But it is important to actually understand this will become redundant, in my opinion, more or less obsolete, because the magnitude of these events will become less and less over time. So topic 5, my 5 core principles when investing in different assets. Number 1, fundamentals first. So top tier projects typically feature a skilled team, experienced and transparent, a viable product with real market fit. So this is really important. There's so many projects out there in the world that have a project and they don't really need a token. A lot of them just have it for a money grab, and it's really important to understand why they have one. Is there a reason that they actually have a token? Number 2, my favorite, token value accrual. This is because you're identifying the factors on why the price is moving up. So things like token utility, gas tokens, Ethereum, you need that token to pay for gas or to use that network. So obviously there's demand for that token. We have scarcity like Bitcoin, or revenue sharing like Hyperliquid. Number 3 is tokenomics. This is really important because we have to understand the emissions, supply schedule, and inflation impacts of different tokens. So strong projects align governance, staking, align their structures and distribution with long-term growth. Number 4, this gets a little bit more analytical. This is what I do on a daily. So using platforms like DeFi Llama, Dex Screener, Misari, Token Terminal, you can actually get some really good metrics on the performance of different tokens. And number 5 is social proofing, which is understanding the hype of a token, which is still important, not as important, but it's good to understand the growth in holders and trading volume and things like that. So on the screen here, we just got a few charts. Revenue in the top right. Hyperliquid stands out here. It does $3 million in revenue a day, which is quite a large amount. And the important thing about this is that 97% of the revenue that Hyperliquid actually earn is used to buy back and burn their token. So that increases the demand of the token while decreasing the supply of their token. And that's why we've seen it being one of the best performing assets in the last 2 years. In the top left, we have token value locked. So this is the amount of liquidity or money moving in ecosystems of projects. So obviously, if you have more developers are going to want to use that network, for example, Ethereum. And then obviously more users will want to come because there's more developers. Becomes basically a flywheel there. And then finally, the bottom left is daily active users. And this is really important because the more daily active users kind of shows the product market fit. If you've got a flat line, no one using it, probably is a project that doesn't really need to exist. Oh. Perfect. So topic 4, final one, is portfolio management and diversification. So thinking like a sophisticated investor, a lot of people invest like gamblers, not like investors. Sophisticated investors have one question, which is, what is the benchmark? And in crypto, it isn't the US dollar, it is Bitcoin. So this is what you have to understand, that a lot of people do look outside of Bitcoin to get better returns. They want to chase a 10x, they want to chase a 100x because they think they can make money quick. But a lot of the time, if you're taking more risk by allocating outside of Bitcoin and you're not making that outperformance, then there's an issue there, because you may as well allocate to an asset that is going to perform and have the lower risk profile. So this is what a lot of sophisticated investors do. They try to accumulate as much Bitcoin as they can, and if that asset isn't outperforming Bitcoin, then there's no point of you being allocated to it. So there is a big thing on that, and that is Bitcoin's dominance over the last couple of years just goes to show. So the importance of diversification, a lot of people, I feel, don't really understand that crypto, there's multiple cryptos in the world and they have different utility, they have different purposes, they're not all the same. So you can actually diversify like in any market, which is extremely important for maximizing opportunity and minimizing your risk. So for example, we have things like blockchain infrastructure, like Ethereum, Bitcoin. We've got DeFi, like decentralized finance, Uniswap, Aave, AI gaming, and then real-world assets like tokenization and the fractionalization of real worlds. Last slide, sorry. Awesome. So why few people outperform? Crypto is fundamental, and the fundamentals are technical and complex. This is why most people struggle to understand, and most people will just blindly invest because their favorite influencer said so. And this is what, leads to most people losing. And I say, if you're amongst the top 5% who actually go out there and understand the technology, understand what the thesis is behind these assets, you will have a massive edge and you will outperform the market. So don't be a part of that 20 to 30% that the 70 to 80% that are not in profit. Those are mainly the retail investors, and the institutions are the 20 to 30 that do their due diligence and research. So thank you guys. If you guys have any questions, please meet me over at the UpTrade booth. Thank you so much.